What's up, everybody? What's up, everybody? It's your boy Chris. It's another amazing episode of Financipation's channel. It's all about making money, saving money, building generational wealth, and financially emancipating yourself from generational poverty. On this channel, everybody, I give you a six-figure MBA level worth of investing and financial knowledge for free here on YouTube. And the things that people typically spend hundreds of thousands of dollars to learn in grad school, I give it to you for free here on Financipation. Before I get started, I also give a shout out to Charitable Solutions. They're one of my sponsors. If you need digital marketing, website development, or someone to essentially edit your YouTube videos, they're the best in the business, meaning all of your digital needs. Also, please hit the notification bell as well so that you know when I drop my weekly content, okay? So, let's play a scenario really quick, okay? Let's say you're in corporate America or you're working a trade and you're busting your balls and you just got a nice $25,000 promotion at work, but you're scared that your taxes are going to go up because you are now in a different tax bracket. Well, everybody, in this particular podcast, we're going to talk about 7 ways to avoid what I call tax bracket creep. And with that, let's get started. The first way to legally lower your taxes and to avoid tax bracket creep is to maximize your retirement contributions. So at the time of this recording in 2024, you can contribute approximately $7,000 to your IRA if you are under 50 years old. You can contribute approximately $23,000 to your 401k if you are under 50 years old. And if you are over 50, you can contribute approximately $8,000 to your IRA and $30,500 to your 401k if you are 50 and over. These are the tax efficient accounts, everybody, that lower your taxable income. So, for example, let's say you are a 41-year-old man or woman that makes $100,000 a year. Let's say you max out your 401k, you put $23,000 into it, and you max out your IRA, and you put $7,000 into it. So even though you made $100,000 in 2024, you've legally lowered your taxable income by $30,000. So that means the IRS will only tax you on a $70,000 a year income. People, legally lowering your taxes by $30,000 every year for decades will save you millions of dollars over the course of a 50-year working lifetime, depending on the state in America that you live in. The first way to legally lower your taxes and to avoid tax bracket creep is to max out your IRA and your 401 contributions every year. Next, the next way to legally lower your taxes and to avoid tax bracket creep is to max out the health savings account, otherwise known as the HSA. So, if you follow my channel, you know that I am a huge proponent of the HSA. And in my opinion, out of all the taxable efficient accounts that are available to most Americans, this is the best one. The HSA is superior to the IRA and to the 401k because with an HSA, it lowers your taxable income, it grows tax-free. And if you have a qualified medical emergency, you can take out the funds tax-free. In other words, everybody, it's a triple threat. At the time of this recording in 2024, a person that is single can contribute approximately $4,150 to the HSA, and a person that is married can contribute approximately $8,300 into the HSA. So let's say at the time, this 41-year-old man or woman that makes $100,000 a year and they are married. And let's say they max out their 401k, they max out their IRA, and they also max out their HSA. Well, everybody, $23,000 plus $7,000 plus $8,300 is $38,300. That means that in this example, this person that makes $100,000 a year has legally lowered their taxes by $38,300. This means that even though they made $100,000 a year, the IRS is only going to tax them on $62,700. This means that a person that makes $100,000 a year has legally lowered their taxes by $38,300. This means that even though they made $100,000 a year, the IRS is only going to tax them on $61,700 for that taxable year. In this example, this person has legally lowered their taxable income by nearly 40% every year. The next way, everybody, to legally lower your tax and to avoid tax bracket creep is to max out your HSA every year. Next, the next way to legally lower your taxes and to avoid tax bracket creep is to defer payments and payouts. So if you sold a house or you collected a severance package from a job that recently laid you off or fired you, or you sold a very expensive piece of artwork or a very expensive heirloom, you can expect to be taxed on that money. It's worth considering whether you should collect that money in the next calendar year if the additional money throws you into a higher tax bracket. Secondly, if you are thinking about selling stock that has significantly increased in value, you can think about selling it over multiple years so that it also doesn't throw you into a higher tax bracket. Or let's say you are an independent contractor or you're a professional that moonlights on the side, or you're a very successful YouTuber essentially that's making money off of his channel, and you want to essentially invest that money over a certain amount of years so that it does not throw you into a higher tax bracket? Well, you could also consider delaying the payments or simply breaking them up once again over several years so that you do not jump into a higher tax bracket. For example, Financipation, I'm a mechanical engineer. We live in a world full of numbers. I always give examples for what I say. Let's say you are a single filer, single man or woman that makes $85,000 a year in your 9-to-5 job in 2024. But for your side business, you also made $20,000 in 2024. That would mean in total, you made $105,000 in 2024, because 85,000 plus 20,000 is $105,000. Well, according to IRS.gov, if you make between $47,000 to $101,000 a year, that puts you in the 22% tax bracket. That would mean if this individual added all $20,000 of their side hustle money into their modified adjustable gross income, they would instead jump from the 22% tax bracket to the 24% tax bracket because they made too much money that year. They essentially would literally jump to a higher tax bracket and pay more in taxes. If this were my client, I would therefore advise the individual to stagger the $20,000 payments and only take $10,000 in 2024 and accept the other $10,000 in 2025. So their modified adjustable gross income in both years was only $95,000. And a $95,000 a year income keeps you in the 22% tax bracket. In the finance world, everybody, we call what I just got done explaining the backdoor payment system. And doing this, once again, allows you to stay in a lower tax bracket legally, whereas if you add all your money in one particular calendar year, you would legally have to jump to a higher tax bracket and therefore pay more in money. So learn your tax bracket, everyone, and keep in mind that as you are getting your side hustle and inheritance money, always keep in mind what tax bracket you're in and what tax bracket you want to go into. The next way to legally lower your taxes and to avoid tax bracket creep, everybody, is to defer payments and payouts depending on what the actual money is and where it's coming from. Next, the next way to legally lower your tax and to avoid tax bracket creep is to understand the Roth and the Roth conversion. If you follow my channel, you are well aware of the fact that I push my listeners to use Roth IRAs and not traditional IRAs. I push my listeners to use Roth 401ks and not traditional 401ks. And I push my listeners to use Roth SEP IRAs and not traditional SEP IRAs. The reason, everybody, is simple. In layman terms, everybody, with the Roth, you pay your taxes today and your money grows tax-free down the road. If you do not go with the Roth anything, you pay your taxes down the road and you don't pay your taxes today. So what ends up happening is this. Let's say you have $1 million in your nest egg because you invested into a traditional IRA, a traditional SEP IRA, or a traditional 401k. And when you retire 25 years from now, you think you have $1 million in your nest egg, but essentially, everybody, because of taxes, you only have $650,000 in your nest egg. How many of you guys would like to retire thinking you have $1 million only to find out that you're only going to walk away with 2/3 of that? That is essentially, everybody, why I personally tell everybody to go with Roth IRAs, Roth 401ks, and Roth SEP IRAs. Secondly, unless you've been living on a rock right now, you are well aware of the fact that America currently has a huge national debt, everyone, of currently around $36 trillion with the T dollars. And at some point, everybody, some future president, whether they're a Democrat or a Republican, is going to have to get serious about this national debt and drastically raise everybody's taxes. In other words, everybody, we don't know when this is going to happen, but it's going to have to happen because historically speaking, right now, our taxes in America are historically low. And as a result of that, America, once again, is going to have to get serious about our taxes and raise everybody's taxes. So my personal advice is you should pay your taxes today when they are historically low under the current administration in 2024. And then when another president down the road raises his taxes, you're good to go. The next way, everybody, to legally lower your taxes and to avoid tax bracket creep is to take full advantage and to use Roth IRAs, SEP Roth IRAs, Roth 401ks, and any account that has the Roth component in it. Please hit the notification bell so you know when I drop new content. Please hit the like button, share the video, comment, and subscribe. It helps the algorithm and allows me to bring you free content as I'm giving you an MBA level worth of investing and financial knowledge for free here on YouTube. Next, the next way to legally lower your taxes and to avoid tax bracket creep is through asset allocation and to know exactly what you are buying. So if you follow my channel, you are well aware of the fact that I am not a fan of mutual funds that are actively managed, and I am a huge proponent of passively managed index funds. I'm going to film an entire podcast on this, everyone, about the power of the index fund. But the reason, everybody, is simple. 96% of mutual funds are ran by financial professionals that can't return over 8% over a 15-year period. And on average, they only return 4% a year. whereas index funds in the S&P 500 have averaged around 11% over the last 50 years. Secondly, the average mutual fund has an expense ratio of around 0.4%. That means for every $10,000 that you make in your mutual fund, you pay $40 to the mutual fund manager. Whereas the average index fund or S&P 500 has an expense ratio of only 0.05%. That means that for every $10,000 that you make in the index fund or the S&P 500, you only pay $5 to that particular fund. It should also be noted that mutual fund managers and or financial managers that charge you 1% when you factor in capital gains taxes, fees, and their commissions will cost you around 28% of your retirement portfolio. Think of it like this, everybody. If you go with a mutual fund manager that says, I'm only going to charge you 1%, when you factor in their commissions, when you factor in their fees, when you factor in the fact that you're losing compound interest, over time, if you retire within $1 million nest egg, you would only walk away with about $700,000 when you retire at 65 by going with a mutual fund manager that only charges you a 1% commission fee. So everybody, know what you are buying, because I don't know about you, but if I thought I was retiring with $1 million and I found out I was only retired with $700,000 because my mutual fund manager, my hedge fund manager, my financial advisor was only charging me 1%, that essentially over a 30 to 40 year investment period accounted for $300,000 of loss to me, I would be pissed. I'm gonna be real with you. I would therefore advise all of you to invest into the S&P 500, total stock market index funds, real estate, and land. And I would tell you to avoid going with mutual fund managers and actively managed funds that essentially cost you money over the long haul and that are vastly inferior when it comes to their returns. The next way, everybody, to legally lower your taxes and to avoid tax bracket creep is to know what you are buying and to maximize your asset allocations in the right sectors. Next, the next way to legally lower your taxes to avoid tax bracket creep is through qualified charitable donations, otherwise known as QCD. For my older listeners that are in retirement and who have to take out required minimum distributions or RMDs, you can make a qualified charitable donation from your IRA of up to $105,000 per individual or $210,000 if you were married or filing jointly, as long as the charity receives your donations by December 31st. The money you donate is not tax deductible, but it is subject to federal taxes. It qualifies for your RMD for that particular calendar year. And qualified donations or QCDs are allowable starting at 70.5 years old. And your payments at the time of this recording in 2024 have to be made payable directly to a charity. And keep this in mind, not all charities qualify for them either. So the next way to legally lower your taxes and to avoid tax bracket creep is through qualified charitable donations. Next, the last way to legally lower your taxes and to avoid tax bracket creep is via deductions and charitable contributions. So if you follow my channel, you are well aware of the fact that I am a very big proponent of helping poor people and those that are less fortunate than we are. From my experience, people that consistently give their time, their money, and their resources to help the poor almost always get about 10 to 15 times more in return. It's almost like it's an investment that you're basically putting out there in the universe, and the universe and God himself rewards you by sending you more money, more resources, and better time. So if you have extra money to give this year, you might consider concentrating on charitable donations in a single year and then skipping the following year. The next year, you would not be able to claim charitable deductions, but you would still qualify for the charitable and for the standard deduction. Secondly, if you put your contributions into a donor advised fund, you can spread your giving out over many, many years. And this is another backdoor way where you can essentially legally pay less in taxes. And in addition to money, you can also deduct property as well. So you can get that slightly used couch or slightly used older TV that you have to a local church or to a local school. And the last way, everybody, to legally lower your taxes and to avoid tax bracket creep is via deductions and charitable giving. This channel, everybody, is all about making money. It's all about saving money. It's all about building generational wealth, and it's all about financially emancipating yourself from generational poverty. You can book a one-on-one session with me at any point. The link is below. Thanks for listening, everybody. Please check out my website, www.therealfinancipation.com. Check me on Instagram, @thereal_financipation. My Spotify is Financipation. My TikTok is Financipation. And my Facebook page is Financipation. Check out my financial blog, Financipation, as well, just like it's spelled in that sign. And thanks to Token Solutions for all these other dope graphics, okay? Please like, please comment, please share, please subscribe. It's your boy, Chris. I'm out. Take it easy, everybody. Peace. Peace.